Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Saturday morning, again, it's the weekend. So welcome back for another weekly market recap. And the week which just ended was pretty interesting, I must say. Although, it leaves the doors open to many different stories. And for me personally, don't know about you, but for me, a little bit of a conundrum when it comes down to how yields moved this week. Not for the movement itself, but, for the potential logics and reasons behind it. But, as you know, at this point, there was the FOMC meeting, the press conference, which followed it. And then we got what? A yen intervention, and this time it was coordinated in between the BOJ and apparently the Fed, all right? And then what? Of course, we are still going through earnings. This week we got Amazon, Meta, Microsoft, and I think Apple later in the week. I don't really remember the order now. But, as you can see, there was a lot. So let's start out as usual, briefly, with the economic calendar, because we got a few data points coming in. So PC, the Fed preferred grasp on inflation or inflation expectations, which came in negative as for the month of a month. Again, kind of like the same story with the last CPI print. Most of that was due to oil collapsing throughout the month of June. But, if you check the price of oil now, you know that it rebounded like what, 18, 20%, something like that. So, there was a huge bounce in that. So it's totally possible that the next print may be a little bit higher than the current one, obviously because it's negative, all right? So other than that, the core instead, it came in at 10 basis points. It was expected at 2, so not a huge deviation from expectations. So you could say, well, at the end of the day, the core didn't move, so the volatility in the overall inflation data that we are getting recently, it's obviously more often than not due to the energy swings, the energy price swings, right? So, very volatile, very hard to predict because it depends on geopolitical events, on wars, on conflicts and all the rest. So, already right there, I'm starting to think, okay, so why the FOMC press conference would matter? If everything we are getting in these data sets, it's due to something which is out of the Fed purview and control, why are they so upset, right? To start out, right? So year over year, PC was at 3.7, so down a little bit from the previous read in May, and, all in all, in line with consensus. So, that came in line. Then we got personal spending, which came down a notch, obviously, because of what? Again, if energy, it's costing you less or a little bit less than before, you're going to spend a little bit less because energy is reflected basically everywhere throughout the economy, okay? And then we got personal income, which it came in positive, but as you can see, the majority was due to employee compensation, income receipts on assets, and government social benefits. So, I wouldn't say it's because the labor market or the economy as a whole, it's really on fire, all right? And speaking about the economy, we got GDP growth rate, and it came in at 1.5, so below the previous read, Q1, and I think below expectations because it was forecasted at 2.1, yeah, so it was a miss, right? Then again, so you see inflation data slowing down, which again, of course, it's due to swings in energy prices. Okay. But, at the same time, you see GDP slowing down overall, right? If you think about the end of 2025, right? So pretty lower compared to the reads of the previous year, right? So again, the economy, it's not dying completely, but, at least you can see that it's slowing down. It's cooling off a bit. Which again, to me, it's a little bit of a controversy because you see inflation expectations as priced in by the bond market, especially this week, kind of going up, right? You hear Kevin Walsh talking about being adamant on bringing the inflation down to target, which is, in his mind, it's still 2%. And he restated that. Him and then I think even Waller this week, they said, no, we didn't move the target higher. We're not talking about 2.5 or 3%. We're not willing to accept a higher rate of inflation as a target than the 2% that we have kind of targeted for like 15 years. Doesn't matter if we never reached it, like, inflation was steadily at 2% for what? Maybe a quarter or two, and all the rest, for 15 years, we were below target after 2008. And then, again, with the pandemic in 2020, inflation got up to 2% and then up to 9%. And it never came back to target ever since. So 15 years below it, now basically 5-6 years above it. I mean, I'm wondering if this inflation targeting actually makes sense. I don't know. Personally, I don't think it does. But, that's the world we're living in, all right? Finally, United States, University of Michigan consumer sentiment, which it's rebounding a little bit, but as you can see, the trend over the last 10 years, still not encouraging. But again, with all the caveats in this one, the political biases which go through this, we kind of walked a little bit through that logic and to that process, I think last month. So take it with a grain of salt. Probably the consumer board sentiment gauge is a little bit of a better measurement for now. But, nonetheless, that's what we got. So let's have a look instead at what the break-evens did together with the five-year forward inflation expectations. Seems pretty flat to me over the last month. So, I mean, this week, it looks like it bounced a bit after nosediving the previous week. But, if you look at the month of July in its entirety, it's kind of chopping around. It's not really going anywhere. All right. So, are we going to see inflation again? I think, look, if GDP is slowing down, right? Not dying or falling off a cliff, but slowing down, right? If this section of the bond market, it's not priced in inflation, if interest rate swap spread are basically negative again, right? On one hand, I mean, you can follow the current narrative about, oil going to 200, inflation being a problem, rates going to 8, 9, 10%. But at the same time, the same bond market, at least, in this particular section, which is all oriented, right, to show you what type of inflation protection desire, appetite is there, it's not showing a lot. So a lot of controversies for me. And again, this is why I said it's a little bit of a conundrum to some degree. Then again, unofficial data like Trueflation giving you CPI at 2.10, PCE 2.60, basically. FedWatch tool, of course, it's telling you that they are now expecting a hike in September. Will they hike? I honestly, I don't know. I mean, this is particularly volatile. All it takes to completely turn it upside down, it would be next week. We're going to have NFP. If they are negative or, massively bearish, you may see these odds completely shifting around. So I would give it time. All right. So, I don't really look a lot into it for now. I wouldn't read a lot into it. Now, a little bit now of charts, because, after all these data, right, and all of these considerations, so to speak, you then look at the charts, right? And I want to start out with yields this week, right? Because you see that, the 2-year, it came down. If you zoom out on a weekly time frame, as you can see, it was a negative week. It was negative at the end of the day. But the 10-year and the 30-year, right, they went up. And, the long yield went up massively, right? You can read about it, or basically pretty much all the front pages of financial newspapers this week, because, we got back up to historical highs. I think the 20-year highs or something like that. That was 2007, it looks to be like here. So, obviously it makes news, right? But then I kind of like, this is where my conundrum actually starts, right? So, because I think, look, okay, the Fed poses, right? No, they didn't move rates, no hikes, no cuts. And you see the short end coming down, actually, because you could argue the short end of the curve, it's basically where the Fed can have an influence. The rest, it's basically driven by market expectations about growth and inflation. Okay, I actually subscribe to that thesis. Then, if the yields are moving higher, do they expect what? More inflation? More growth? Okay, but GDP is slowing down. So, and they keep on saying, the majority of the American consumers are basically tapped out. They couldn't sustain another, energy spike, yada, yada. Okay. And then they tell me that, if you read the stats, that basically 50% of consumption right now in the US, it's basically fueled by 10%, the 10% in the, higher income tier, right? So, I mean, I don't really know how to reconcile all these movements. And again, although I will be the first to admit this is just my personal opinion, and it's just a thesis, or let's call it a thought experiment. But since we have seen, right, a yen intervention this week, right, and supposedly the BOJ spent a lot, 53 billions or whatever in order to kind of rescue the yen. Where do the money come from? Because, I mean, I'm the BOJ, right? Just bear with me for a minute. I'm the BOJ. Okay. I got a lot of reserves, mostly in treasuries, because I'm like one of the biggest holder of treasuries, right? Together with China and the UK. Okay. If I need money, if I need dollars to then swap with yen to defend my currency, is it so illogical to think that maybe I just sold a lot or a good chunk of those long-term, long-duration bonds that I had on my balance sheet? Obviously, I didn't sell the short duration because potentially I just bought them over the last 2-3 years, and I was able to lock in a good rate, a good yield on them. So why would I sell them? I would rather sell something which at this point it's not yielding you anything, right? And potentially, if we keep on going like this, it's going to go down in value. So I don't know. It could be that in order to finance this intervention, they kind of sold a little bit of their reserves. Should actually check. I guess they would report what type of balancing structure they have. I didn't take the time to check it, but it was just a thought experiment because everything is basically happening in locksteps, right? So from a price action standpoint, the logic would be justified. Although again, this is just me. I don't have solid evidences to support that, right? But nonetheless, this is what we've seen in yields. And again, it starts to be a conundrum because Kevin Walsh, although it didn't move rates, it was particularly hawkish, right? Okay. So, I mean, if you expect that the Fed actually has an impact on the bond market and where yields should go, I mean, if he is particularly hawkish, and it's been like that, even the previous meeting was like this, right? Why then the long end is going up, right? Because if you think about the economy, right, the economy doesn't borrow at Fed funds, right? If you go to ask for, a loan to buy a car or a mortgage to buy a house, you're not getting Fed funds. You're getting most likely either the 10-year yield or something close to it with a little bit of a premium, obviously, or a 30-year, right? If you take out a loan for 30 years, you're going to get something which is slightly above the 30-year government bond yield, which is considered the free risk rate. So, these are the rates, the left and the center, which are impacting the economy for real. And that's where you can start making a lot of hypotheses. Because, look, if I pause, so I don't hike, am I signaling to the market that I'm not determined and resolved enough to fight inflation, and therefore the market starts to reprice inflation expectations higher at the mid and long end of the curve? Maybe they think I'm not aggressive enough. But on the other hand, let's say instead I actually hiked. I raised rates by 25 basis points, which I don't know what the fuck would change for the actual economy and how it could impact the flow of oil getting out of the Middle East, but whatever. Let's just say I do, right? I do it. Then what? If that's how the price moved, right? You could argue that maybe if I actually hike rates, the market could have said, you know what? The economy is already cooling off. If now we hike rates and we signal the intention of being more hawkish, more aggressive, and, you know, the aim is to cool off the economy even more, at this point, maybe these yields on the mid and long run will come down because they would start to price in a damage to the economy, which would be done by monetary policy being too tight. So, you know, you try as a Fed, you know, you try to signal something and the market response is completely opposite of what you would expect, right? But then again, you could also argue that Kevin Walsh was particularly smart because he said, you know what, from now on, instead of relying on forward guidance and trying to signal the market what we would like it to be, we would let the market actually do its job. And so you say that, you know, the market is going up, at least the yields, right, are going up at the medium and long end of the curve. So in a nutshell, me, Kevin Walsh, or me, the Fed, I actually tightened financial conditions without doing anything. I'm letting the market doing the job for me because even I recognize that Fed funds doesn't mean shit for the real economy. So you start to see many different interpretations. And quite honestly, at this point, or at least as for today, I don't know which is which, right? This is why I talked about the conundrum, because I don't know, honestly. And, you know, if I knew, or if I had a reliable thesis sustained by data or evidences, I would have brought it up, but I don't have it. And for now, all I can say is that yields are keep on climbing. I do also think that, you know, might be just some sort of a knee-jerk reaction this week. I would like to see another week of price action to either confirm or deny, right? Especially, again, where we're going to have labor market data coming in next week, but I don't have really a lot of evidences for now for whatever thesis I could come up with. All I know, again, if I keep on trying to put myself in the shoes of Kevin Walsh, is that from here on out, back, up until the next meeting in September, I'm going to be able to have two more data, both on inflation. Like we're going to have another CPI print, right? We're going to have at least another two payrolls data. So maybe when I come back in September, I might have a much clearer depiction of what the actual situation is if I let the market these 2 months to actually do its job, right? So that part of the strategy, which is now implemented by the Fed, I can kind of agree with. Just let the market do its thing, right? Which, incidentally enough, as he said in his press conference, it was right at the beginning of the question time, right? If you go and look and check the replay, you're going to see it. He says that the market is particularly good at setting prices for stocks, equities, so the equity market, for goods and services in the real economy, and for even interest rates at the long end of the curve. So again, my objection would be, if the market is so good and efficient in setting prices where they should be, why the fuck are we moving the Fed funds hoping that we are gonna achieve whatever result? Especially when you try to do something and the market responds completely opposite of what you would expect. Again, assuming, like Greenspan was saying, that monetary policy works in the sense that the Fed moves this tiny little thing here at the short end of the curve, and all down the chain, the rest of the curve, it's a series of forward rates, which again, it was proven wrong many, many times on that one. But again, that's another story, okay? So all in all, we can just register, again, yields moving to the upside with a little bit of a controversial type of signal, because these other section of the bond market didn't move, actually, right? Didn't follow along with yields going up. So that leaves the door open to this very naive, if you wish, doubt about maybe someone actually liquidated a lot in order to get the money to then rescue the currency, right? So, if you want to try to connect a few dots, that could be one interpretation. I'm not saying, again, Not saying this is a particular good one. It's just the best I could come up with in this brief little time that I had since the weekly close on a Friday night. All right. Now, let's try to move on. In all of this, you see the DXY actually plunging again because of a coordinated intervention, mainly, right? In between the BOJ and the Fed. Obviously, if you see the JPY going up, it's a good chunk of the index. I think it's like 20%, something like that. Maybe a little bit less, maybe, because the euro, it's almost 60%. You're probably around in between 15 and 20% of the DXY, although, right? So, it's going down. So this intervention was most likely oriented to strengthen the yen, but apparently it looks like it was good enough to strengthen all the other currencies, right? Like, you see the euro rebounded, the pound rebounded. Canadian dollar, yeah, it came back up a little bit, right? And even the Swiss franc, but to a much lesser degree, okay? So we were looking for a while this area. At this point, we kind of bridged it back to the downside this time around. I keep on thinking, still the potential for a bounce from this area because it was basically the origin of the previous move to the upside. So again, usually these spots tend to have a good reaction. A lot of that, it looks like, was already happening on a Friday, and we closed near the low for the day. So, just saying, look for this spot, or at least before saying, okay, the DXY is done, it's probably going to go back down in the middle of the range. Just wait for this level to crack, right? But, the direction seems to be set, but I keep on thinking these interventions, they have a high risk of being short-lived, all right? And then market forces eventually take over. So just, again, same as for yields, give it another week and let's try to assess what's going to be next week, because I think it's not said and done yet, all right? We already checked the other currencies, so we just need to check the exotic, so to speak. South African rand rebounded after breaking down from this wedge. All right, okay, nothing new here, if not the bounce. But we didn't really reclaim any relevant level for me yet, up until the point we climbed back above. 61 most likely, 0.061, something like it. All right, Chinese yuan still going up. There was even a little bit of a rebound in the India rupee, okay? Brazilian real, which I think looks inverted. There you go. Brazilian real still drifting to the upside, very choppy action, but still maintaining this old level and trying to bounce off of it. So, for now, still good. Australian dollar rebounded, especially again after Wednesday. So, overall, not a lot to read into it for me. Russian ruble still drifting down instead. Okay, so we had this massive run up, and then it looks like we're giving it all back. Oh, okay. So that would be it for currency. So, already two themes of the week, right? FOMC, controversies raised by the press conference, potential impacts on the bond market, especially paired up with the intervention, the coordinated intervention this time around. And again, GDP cooling off, inflation expectation metrics, break-evens, not moving a lot, yields actually moving, all right? And then you have, if you want to think about inflation and what could move yields up and down, or inflation expectations up and down, oil bouncing, it dropped back to this level once again, right? And it bounced right off of it, and it came all the way back up. So we closed at 87. If you zoom in, I think it's, you see, right? We cracked it, retest, bearish retest, down we go. We came back up, reclaimed it, hold, up we go. Down we come back and, bounce off of that level. And we are doing what? Oh, well, filling in this gap, I guess, which I think it's the weekly opening gap, right? Yeah, pretty much. We gap down at the open on a Sunday night, so yeah. So what's next? Again, I think it's very headline driven. It came back down because they announced a pause in the bombing of Iran, and now I was reading just I think 20 minutes ago, Trump ordered a new series of attacks on Iran. It could last a few days, and it could start as soon as this weekend. So who knows? Was the oil market sniffing that out? For now, I would say just trade it, if you trade it, level by level. So again, in this case, right, do you remember last week? We close in here, right? So I said, if we can hold this level, probably we should be a bit more bullish, all right? Although we reacted to this point of release, right? So as soon as we open, we gap down, and that means obviously that we didn't hold this level, right? So we came back where? All the way back down to the other relevant level, or, nearest of the relevant level, if you want. We bounce off of it. So now again, same level to watch right here. So look around and what happens to this level. Are we rejected once again? And maybe we can start to depict some sort of a dealing range if we see another rejection in here. Or will something escalate in the Middle East and we reclaim this level, we use it again as support, and we try to push higher, right? So if this and that, I guess, in a market like this, which could change on a dime, depending on what news comes out, I would really just try to react based on the levels which are, reacted to, breached, broken, reclaimed. I wouldn't have a long-term type of view rather than a short-term type of tactical play on this one, because it's, at this point, it's really too hard to predict where oil will be, let's say, I don't know, in 3 months, right? Although someone is trying to do that, but this is why we have a market, right? If you check the futures curve for the oil market, again, all lower prices into the future. So, at this point, you start to wonder, is it just wishful thinking? It's like a hope. The market is hoping that all of these go away. One way or the other, the Strait of Hormuz gets opened up, and we can come back down to a kind of quote-unquote normal situation. Or do they see some sort of a demand destruction type of dynamic by which, oil will be elevated for a while, and then it will come back down because demands will just evaporate. You know what they say, the cure for high prices are higher prices. So you could also argue that. I do realize, today I'm not particularly full of answers, right? I got more questions than answers, but I guess, from time to time, having those weeks where you start to reassess things, and instead of, being particularly sure on a thesis or having a very clear opinion, those times where you start to think and try to evaluate all the scenarios potentially, those are the times where you can actually, save up a trading account or an investment portfolio if you wish. So, it's good not having a proper idea or a very short-term strong bias sometimes. If you don't take positions, you're not putting on risks at the end of the day. So you're not at the mercy of the market. So, right. Then what we got, I think after oil, it's really nothing else which could be linked to, wars, inflation, yields. So let's try to move on to gold. We got gold next, which again, this week didn't really move a lot. It started out and it came back down, and then, after FOMC, it came all the way back up, but then closed Friday on a little bit of a weak note. So still ranging behavior. We are still moving in this range for now. Can this be good? again, if you want to start to see some sort of a rounded reaccumulation right here, okay, a bit early to tell. I mean, to start out, in order to assess some sort of a resolution on these potential reaccumulation, you would need to start breaking highs, right, and developing some sort of a bullish structure. So this level right here would be the first. Then you would have potentially this one right here, right? So for now, can't really see it. So the doors are still open for a little bit more of the same of what we have gotten so far. Probably another test at the lows, probably another bounce, right? Up until the point you don't see it, crack it, right? And at this point, we have room to go to 3,700 or something like that, I would say. But for now, up until the point the range, it's a range. If there is no breakout or breakdown, don't see anything there. Other metals, they did fuck all this week. As you can see, silver, dead heartbeat. Same for platinum and palladium, right? Copper instead, copper kept on being bullish again. Not the best market ever in the sense that it's not really going straight up, right? But it is steady. It is constant. This is efficient price delivery. This is efficient movement. This is sustained bids showing up. Every time it comes back down a notch, you got bids coming in, right? And it goes up a tiny bit. It comes, it draws back, find new bids, and it goes back up. Comes back down, find new bids, and they push it higher. So, that's sustained demand, in my view. At least, the way the price is moving right now would show you that. Yeah, sure, ugly, slow, maybe, but, this is actually strength, right? As counterintuitive as it might be, but this is strength. These right here, not necessarily strength. Or these right here, not necessarily strength. These, steady pace to the upside, to me, is always strength. All right, or at least, it's a price action which is less prone to sudden and sharp pullbacks because we are building a lot of volumes on the way up, right? So, that would be it. Let's have a look instead at Bitcoin, which ironically kind of broke this momentum. Do you remember? We were looking at, this sort of a channel, if you want to call it that. It was moving to the upside, higher highs, higher lows, higher highs, higher lows. And, the only thing we said was, well, look, up until the point you don't break this pattern, should be bullish, all things considered. Ironically, we did break the pattern right on Monday. We came all the way down, and then we spent the majority of the week basically trying, right, to retest the channel, which was just broken. And then on a Friday, we had this bearish candle, which almost, the close is a little bit above it, but basically we took out the weekly low. We managed to not close below it, but I mean, we basically shut off all these buyers right here. So I'm not saying it's completely bearish now, but, it's not bullish anymore. So at the very least, you could say neutral at this point, expecting a bit more of the same. Range high is here. Range low would be kind of here. So maybe we keep on moving in this range for a little longer, right? Because again, it's not going up anymore. At least it's not going up with the same structure, which was manifesting before. So, how do we come back to be bullish on Bitcoin? I think, obviously, you have this high right here, right? This one. So, reclaim that. Start to trade back in this sort of a channel. And you could categorize these as what? As a dip, which was bought, as some sort of deviation out of the trend, and then getting back in. A probe to seek liquidity, fresh inventory below it. But I would wait for something like this to happen. All right. Other than that, I would be a little bit more neutral and potentially, open to a retest of these lows right in here, right? These this. And let's see what we found in this cluster right here, right? So in the eventuality that we drop from here a little bit more, what do we find in here, right? Can we bounce off of it or not, right? That would be another thing, right? So again, even this one, level by level, it's always the best way to approach things, because, you know, the market will show you where it wants to go, right? But you need to give it time. Now, there is really not anything else which could be linked to all of what we were discussing so far. Maybe we already checked the break-evens, the Fed watch. Yeah. So you know what? Let's start to have a look instead at the stock market for the week. So the stock market actually moved a lot this week. We started out the week as for E-mini, S&P futures and NQ futures. Started out the week, and immediately after kind of a boring overnight session, we immediately sell off at the open for the US market, right? And, you know, the rest of the day was basically just the market going down, right? And that was basically the Monday, just to set up the tone for the week. We kept on drifting lower on Tuesday. There was, you know, this huge attempt lower, but it was quickly bought up. So, you know, we started a little bit of a range Tuesday, Wednesday, obviously ahead of FOMC, okay. And immediately you start to see, once again, another type of what? Divergence, because you see that you got these low on Tuesday in NQ futures, but not really the same low in ES futures. So Monday high was kind of protected in this case. And as you can see, the subsequent type of a counter rally was much pronounced, and it went much higher from a structural standpoint in ES rather than NQ. Now, like we actually took out a few highs in ES. NQ, not really, right? So again, even on lower time frames, you can see a little bit of more of weakness in NQ. Then we got Wednesday. The market starts to drop. Then it comes all the way back up. It actually takes out the overnight high, I think, or at least the London session high for NQ. And, then it basically collapses after, the press conference was released. But then again, always remember the day. On Thursday, the surprise was a complete reversal, right? This is why, although you may think, look, the market is looking like crap this week, but when it gets to Thursday, just be on the watch. Right? I'm not saying it's going to happen every single time. This month, July, it happened quite a lot, but, it's not a constant, right? It's just something which tends to happen. Doesn't mean it's going to happen 100% of the times, but Thursdays are usually good days for intra-week reversals, once again. And, this time around it was quite pronounced, right? It started, the London session, and it basically never stopped. It kept on going higher and higher and higher. And then on Friday, not a lot. I mean, the market was kind of sideways. A little bit of volatility spike at the open for the US market, bit of a sell-off, and then the market rebounded a little bit, but it closed below the weekly open for NQ and kind of there for, a little bit above it for, E-mini S&P futures. Now, if you zoom out, what you see, you remember we were looking at, those two different patterns, highlighting again relative weakness in NQ. And, we broke down off this base, and looks like then we came all the way back up. We retested it to the T. And so far, the daily candle looks like a rejection on a Friday. Yes, again, different type of trend line, so much deeper pullback in it. It looks a bit better. Still below it, but it looks a bit better. You could argue it's kind of like the same of what we were looking at for Bitcoin. So, you have a trend, a diagonal in here. We can reclaim it. That could be good. Overall, I mean, with all the talks, right? It looks like the A bubble already popped and all the rest, but you know, at the very end of the day, at least if you look at futures, ES futures, so for the S&P, they are like what? They are down 2.5% from all-time highs. I mean, doesn't look to me like we are in massive troubles yet. You may say, okay, but what about where the real money are for the AI supposed bubble? We are down 9%, right? The trough was at 12%. So, I mean, that gives you the measure of what type of reaction we got on Thursday, that Thursday reversal, right? So, you know, if anything, what you could say, and this is one thing I've always kind of subscribed to, is that although the damage is not huge to the overall market, if you look at the, you know, the main index, the benchmark, the S&P 500, right? But you may say, okay, but upside potential may be limited because if you don't have participation from the sectors like technology, which make up a lot of the index overall, yeah, I mean, maybe not a lot of damage over time, but surely a market which will struggle to go decisively up, right? But at the end of the day, just, you know, if you delete these lines, it just looks like a market which is going sideways for now. Again, I think, you know, this is kind of an important low for now. So even in this case, if you see that low being taken out and close below on volumes, on a, you know, a little bit of a spike in the VIX, something like this, right? Then you could say we are a little bit more into troubles, right? But, you know, because you would end up having this as a rounded what? Redistribution in this case, right? You know, you would have the top, the initial sell-off, the market trying to push for new highs, but being redistributed down instead of bought up. So you're not there yet. We don't know whether we are gonna go there, but you know, I think for now, this is just a time to be, I mean, cautious, I guess. But on the other side of what could seem like a major scare for markets, there is always an opportunity if you know where to look for. And again, when you look at the sectors, we are going to check them in a minute, but you know, it tells you a story which is not about a generalized sell-off, right? Which is why I keep on being a little bit more optimistic than what the price action alone in the charts would suggest me to be, all right? If you look at the underpinnings of the market. Right? Now, on the other layout, again, we see that at the end of the day, look, SPY, the ETF, it basically came all the way back up above all the main moving averages, all right? The QQQs, they almost retested the 200 days moving average. And again, that was, do you remember last week? Would it be just, you know, a far-fetched type of theory that we need to mean revert toward that? And then we'll see, all right? The stochastic is signaling a little bit of a cross up. So it could be, you know, that these bounce overall could bring to a little bit more of a sideways action in this region. You still need to keep in mind that NASDAQ for now, it's really weaker compared to the rest. So bear it in mind, all right? I'm not saying this is going to go to all-time highs, right? Not at all. It's too early to tell, right? Actually, again, we would need to reclaim a few levels first, right? And we would need to maybe trigger a buy signal on the momentum indicator like the MACD, but, you know, for now, let's just register the entire bounce as just a bounce, and we're not out of the woods yet, right? That would be the assumption here. It's nice that we had it, but it doesn't really resolve the entire thing to the upside. It doesn't signal that the correction is completely over, right? There is still potential for, I don't know, another push down, right? So, you know, for now, it's not showing strength in here. Okay. Now that we assess the, you know, kind of like price dynamics and where the market stands technically, let's have a look, as I was saying, to the different sectors, right? Because again, for instance, let's go on a weekly time frame, right? I mean, materials are kind of there at the highs, right? Communication and services, of course, that they are suffering together with technology a bit more, right? Energy near the high, which understandable considering what's going on with the price of oil and gas, right? Financials. I mean, got a few sketches here. Don't know why they're there. All right. No, don't actually know why I got these two lines. Maybe was looking at something in the past, like 2023. But financials, they're not holding up bad. I mean, they just made new highs, right? And then what? Industrial. Yeah, I mean, this week it pulled back a bit, but overall, look where we are, right? And even technology, which seems to be that part of the market which is completely falling apart. Look, we had a huge run, right, since April, and we didn't give back, I think, not even half of it. Let's try to measure from close to close and see what we get. Yeah, not even half of it. So chill out. Come on. I don't understand why people panic out as they have never seen how a market could move, right? So before calling for the next .com crisis or whatever, I would say just look at things and take them in perspective. These markets went up basically what? All, from peak, from trough to peak, it was what? Jesus, the 56%, all right? In basically 2 months, all right? And now everyone is panicking because, oh, look, but then it pulled back 16%. Well, I mean, it went up almost 60. Sure, it pulled back a little bit. Are we in massive troubles? I don't know. I mean, come on. Just try to keep your head over your shoulders for a while, okay? Consumer staples, don't really like this candle for the week. Major rejection, but obviously we didn't break any type of structure for now. Real estate, just going sideways. I'm not a particular fan of this one, to be quite honest. Utilities, they came back down this week. This could look like some sort of top information, but it's a weekly time frame. Might get clarity on it in another month. Who knows? Healthcare up, new highs this week. Although rejected after that, but new highs, right? And then you go what? Consumer discretionary was down, is bouncing this week, but mostly sideways. So I mean, I don't see a huge damage being done in these markets. All right. Now again, we got earnings this week, so obviously we got what? Meta, which reported earnings. It was a beat, but then what? Then it gapped down, right? On the other hand, we got Microsoft, which also reported earnings. It was a beat, and it gapped up. Now, these two are particularly interesting because you might say, if you just look at EPS or raw earnings or revenues, I don't get it. But they both beat the expectations. But why one it's massively up and the other is not? I think the answer lies in something like this. All right. So this tiny little wrapper right here. You see that at the end of the day, they both beat, right? Oh, sure. But, if you look, revenue, they growth in both, right? 18% for Microsoft, 28% for Meta. The problem is what? Well, the problem is that if you check Microsoft, and, to some degree, it's the same type of logic for Amazon, which also gapped up, right? Is that they got a lot of income and growth coming out Azure, which is basically the cloud platform. And, that's a signal that's something that Meta actually doesn't have, right? So again, in a nutshell, Microsoft's spending guidance was positive from a market perspective while the business grew faster than expected. Instead, when they looked into Meta, they saw basically a CapEx, which is not transforming in growth, but it's just eroding profit margins. So, that's the different type of reaction you see. And that's kind of the reason, even with Amazon, we've seen in Amazon earnings, they boosted a lot their revenues from AWS, Amazon Web Servers. And they have a lot of backlog. Now, if you think about a company, I don't know if everyone is updated to these terms, but a backlog, it's basically, you could think about it as revenues which are not completely factored in yet. Like, let's say you sign a contract to supply a client with XYZ amount of goods and services, right? You just signed the contract. You are not supplying the client yet, so it's not paying you yet. But that still future revenues, right? That you know for a fact you're going to have because the contract, it's already signed. Right? So you know that you're going to have those sales into the future. So, companies like Microsoft or, Amazon, they got that on their side, while Meta actually doesn't for now. Okay, so that could be another thing, right? I didn't have the time to check Apple. I think Apple was down, gap down, yeah. Don't know why. Could speculate maybe their sales, their volumes are for sales in, I don't know, China or other foreign markets weren't that good, and the markets, they kind of punished them. I don't know anything else, to be quite honest. It seems to me like Apple, it's not really rushing into these AI infrastructure build up. I'm not saying they are completely disregarding it, but I'm saying they are not so focused like maybe Amazon, Google, or Microsoft would be. But I do also think that's kind of part of Apple philosophy. They expect for the technology to prove itself, to establish itself, to get that consumers respond, which, if it's positive, then they're going to come in later and try to implement and to make better pretty much everything which was already invented and the consumers showed up, manifested interest for. So I think that's a little bit more of how Apple operates throughout times. But again, just my speculations, all right? Now, all the others, if you think about, before going to the individual stocks, let's have a look at, this one right here. So do you remember we're looking at a potential breakdown? We came shy of the target, but, could still reach it, I guess, right? It doesn't have to do it, for certain, but it was just an idea. Head and shoulder, the pattern would suggest this type of measured move in that direction, which aligns up with the 618 retracement from this last, push to the upside. So why not? I would say, after the Thursday reversal in markets, I didn't particularly like the action we've seen in this one as for Friday, because, if you look, this candle, it's bearish, right? Now I use purple, but you could imagine it as red. If it is red, it means that it opened up higher and then price came all the way back down and closed relatively near the low of the day. Maybe if we zoom in, we can see it better. Not really. Let's go on the hourly time frame. See that? It opened right here. It came all the way back down, filled the gap, but then we didn't have that sort of a, like we gap, we open in here, we gap, we closed it, and we go, right? We have some sort of a gap, close the gap, anemic reaction here. So it's a little bit more of a weakness for me, which is why I would say the doors for a little bit more of a downside in this one are still open. It's not a certainty, but considering how Friday's closed, makes me think that could be bounce, filling in this inefficient move down, and potentially a little bit more of continuation chance in this one. All right. We keep on monitoring the semiconductors because we do know that this is a sector of the market which was particularly hot and it's now cooling off a bit. So if you check the individual stocks, what you see, AMD was kind of down for the week, same pattern, intra-week reversal on Thursday, but Friday's closed. don't like it. How do you call it? Gap and if it's not a gap and go, it's I don't know, gap and shit, gap and failure, gap and flop, whatever. So, but not bullish action on Friday. ARM, same. Although, you know, we have the bounce in here, but now it looks like it's still selling off. So SML, it's not the worst considering all the rest, but you know, this one seems like Broadcom. I don't know. These seems like exhaustion to the upside. And then, you know, we came back down. We're now trading below this cluster in here. Seems a bit more bearish. Maybe you know, if we could come down a bit more to 340. I mean, I would rather buy in it there than here, to be quite honest. But you know, I don't necessarily trade individual stocks. Intel still distributing, same pattern. Thursday reversal, then Friday wasn't good. I think it's going to be pretty much all across the board, kind of one and the same for these you know, stocks, considering how the ETF moved, right? So, you know, Oracle, we're going to have to talk a little bit about Oracle later on, but, you know, not surprising to see a stock down like that, okay? Palantir, which I think they will report earnings next week, if I'm not mistaken. So we'll see. Qualcomm, it's really down. So this is pretty much what I would expect for AVGO, something like that, to fill in these inefficient like Qualcomm did, right? SanDisk, same. Say it's basically all the same. So not surprised here, right? But look, now that we kind of looked at the semiconductor space, a few individual stocks, we kind of, you know, try to make clarity on you know, earnings for the Mag 7. I would say, you know, since it was, again, on the front pages for this week, together with earnings, wouldn't be bad to look at these phenomenon, which is going around right, you know, probably this week, but it's very recent. So if you do know what a CDS is, basically a credit default swap, right? Now they are exploding. So you have CDS, kind of an index, so to speak, for the broad sector of hyperscalers, right? It looks like those CDS are basically skyrocketing, which, you know, you may wonder, okay, why? Well, because they basically had, you know, this type of behavior right here, right? The hyperscalers. So, you know, it's a problem of free cash flow, you would say. So all the cash flow, it's running into the semiconductors company and getting away from the hyperscalers. So it's that the problem. So since they are funding all this capex and they are not able to financing that with the cash flow alone, cash flow is actually going negative. Even for Amazon, it went negative this week, all right? And again, you remember Google, but now you see Amazon going negative in cash flow. But again, the market, it's kind of saying, well, you know what, it's fine. I mean, Amazon will be fine. It might be cash flow will be negative for a few months, but they are financing expansion and future growth. So we do believe that, and we see the growth actually showing up already. So that's the difference, I guess. Sometimes you need to look deeper beyond the headline numbers. But again, this could be one of the reasons overall why the narrative is that this credit default swap should go higher, because the hyperscalers are spending a lot, and yet the market is not sure about the future returns. All right. But then you start to look at the hyperscalers, you know, they issue bonds, right? Corporate bonds, right? To finance their capex. They can do it using the cash flow, issuing debt, or by issuing equities, right? Now, looks to me like Oracle, it's really going up, right? The others are, yeah, I mean, they kind of came up in 2026, so there's no deny that market started to price in a little bit of a different risk, but the majority of that seems to be due to Oracle alone, right? And then if you check, every single credit instrument can be compared to what? To the free risk rate. So a correspondent duration, a similar duration instrument, which is what? A treasury bond, right? Paid by the government, can't be defaulted upon, right? So if you look at that spread, you may see what type of a premium is required in order to, lend money to one of these hyperscalers. And the story at this point, it seems to be completely flipped upside down. Because sure, the dotted line, right? It's the 5-year Bank of America index as for the credit spread, right? And you see that, beside Oracle, which is this one right here, which is really above that. So the market is asking a substantial premium compared to a similar duration treasury bond to Oracle, right? But the others, Meta, Amazon in green, Meta in red, Google and Microsoft in blue and purple, they're actually below the 5-year benchmark in this case. So the market is not really pricing in a broad default risk on all the sector of hyperscalers, but mostly they're looking at something like Oracle, which, being in the basket overall, gives you the result right here, but doesn't necessarily mean that Amazon, Meta, Google are in trouble from a financial standpoint, and the market is starting to price in that they are not going to be able to pay down the debt. Which, if you look at the amount of revenues they are registering, it's difficult to think that all of a sudden they wouldn't be able to honor those obligations, right? So again, a lot of narratives, a lot of, same dynamic, fear sells, right? But at the end of the day, I'm not really seeing an immediate danger, an immediate credit risk for these companies, for these hyperscalers, all right? Now, July, this is interesting because we knew that July was supposed to be the best performing month in the summer, right? Turned out it wasn't like that. Like the S&P wasn't so great, and the Nasdaq, let alone the Nasdaq, it's down 9% or whatever you. Semiconductors, you've seen the ETF from what they did. So turned out seasonality this time around, it let us down for sure. But, if you look where the majority of the losses were registered, SanDisk, Lam Research, Marvell, Intel, Western Digital, Micron, okay, the semis ETF, so we were looking at it before, NASDAQ as a whole, right? But then, again, look at the title. The market sold off suppliers, not the spenders, which is ironic because, CDS are going up on the sector for the hyperscalers, and then, for the month, they performed relatively cool, all things considered. Microsoft is up almost 6%, Meta is up 5%, although I don't know if this accounts for the recent drop, but it's just at the end of the day, recently we've seen a lot of selling in the supplier rather than in the spenders, which again would sustain the narrative that the market is looking through all of this and saying, well, you know what? Yeah, cash flow could be negative for a while, but if these companies are actually spending for the future, and over the last 20, 30 years, they have given proof, they show themselves as the best capital allocator in markets. Again, you Google, YouTube, it's stupid. Who's ever going to watch a video on a PC, right? As for Amazon, AWS, why a company which is in e-commerce should invest in AWS, in servers? It's just a distraction. Is it? Right? In hindsight, is it or was it? And they're probably going to do the same with maybe Microsoft Azure. I wonder what people thought about Azure back then. It's registering a gangbuster revenue growth. So I keep on saying, be very careful when you start to bet against these huge companies, because they got so much money that they can create the market they will then take advantage of. they can reshape markets if they want. I'm not saying 100% they will make it every single time. There is a point that even the best thing could fail. Absolutely. It's like life itself, right? At a point, it's going to end. Sure, everything ends sooner or later. But, betting against them, especially now in these early stages of the AI race, I think it's a bit early to call for winners and losers, all right? Then, another chart could be this one. As for July, again, kind of the same. You see which sectors are down and which are up. And again, this ties in with my reasoning about, looking at the S&P as, the index. Wait, there you go. This one right here going sideways. Doesn't look like a generalized, market meltdown because, momentum factor, semiconductors, technology, sure, they are down, okay, but the RSP is up, for instance. So it means that money, capital flows, they just rotated out of the sectors and back into these at the bottom. So it's not like every single sector of the equity market is selling off. Money are just moving, right? Obviously, if you account for the market capitalization weight, the index looks a bit weak, all right? But it's not money completely jumping off ship, right? Okay? So, that could be another thing. So, where does it leave us? It leaves us with a market which still, overall, net, kind of resilient. Money are just moving from one sector to the next. Look at the Dow. The Russell, although, performing particularly well throughout these months, I think, with this move up in yields, I think they kind of felt it because they are very interest rate sensitive, right? The small caps, right? So all the fears, there are a lot of them. There are a lot of narratives. And again, just to close in, let's have a look instead at this one. So the momentum, mags versus momentum. And again, we're now holding the 50 days moving average. So maybe we'll see that rotation. A lot of flip-flop in this one, not a definitive answer for now when you look at the momentum performance versus max performance. As for the rest, you see what? You see that on this rebound, both for NDX in red, SPX in black, what came back down? The RSP. So, again, it's not happening now, but I keep on thinking there will be a point where you will see the entire dynamic being flipped all over again, and you will get back to this type of situation where the market cap weighted index will outperform the RSP, money will flow back into these Mag 7, the hyperscalers, and yada, yada, right? It's just a matter of giving it a little bit of time and giving the market a time to digest all of these and assess the current narratives and the current worries about futures growth, revenues, return on investment, and whatever. But just be patient because the scare now, I think, is threefold, right? On one hand, you basically have, where I have it? You have these, and we touched a little bit upon that last week. You have what the hyperscalers are spending in order to perform this build out, okay? And CapEx is projected to almost double next week, sure. So then you have people like Michael Burry saying, they're not accounting for the depreciation. They are basically spending money now, but they are not registering the actual cost on the balance sheet because they are using amortization techniques, which basically expand the useful life of the chips and the GPUs they are buying now for 6 years. But really, that lifespan, it's closer to 2-3 years, right? And that could be one type of a worry, right? But then of course you have the circular economy, right? They are just registering fake money because it's all circular, right? It's a vendor financing type of a technique, which again, it's true to some degree, right? But at the end of the day, only 13% of NVIDIA revenues are coming off of this loop. And this is not the only loop. You could look at different loops with different companies, sure. But, the other 87%, it's basically just pure demand. So, it may be worrying, but it is something where you have to assess the actual impact of this circular type of economy or financing loop, right? I'm not saying this is a good thing. I'm not saying it couldn't have bad impact down the line, but it's, it's not like saying that all the revenues are fake, right? So, and then, the return on investment. Sure, there was a report which was out this week, MIT Gen AI Divide, which showed that 95% of the enterprise AI pilots showed no measurable profit impact, despite billions spent. So essentially what they're saying, all these companies investing in AI, they are not seeing profit boost from these investments. Sure, so here's where the narrative, a lot of spending, no return on investment. So we are in the dot-com era once again. But, the report also showed that a lot of the failures were due to organizational problems, not technological, right? And at the same time, the same survey said that 90% of workers reported that they are actually using personal AI tools. So again, it's not that these AI tools cannot boost productivity. It's just that maybe you're looking at those effects in the wrong place. And at the end of the day, this report only looked at what the buyers returned. So people which are buying these AI agents, models, whatever, but they're not looking at the sellers' revenue. So, if you believe Morningstar, they estimated that in 2025 alone, the sector in AI produced 100 billion in service revenues, which seems to be more than enough to cover the cost of running these models. So again, you also need to ask the right questions if you want to get to the right answer, or at least if you don't want to be completely deviated out of reality and losing sight of the bigger picture at the end of the day. All right? Because again, you're free to believe it or not, but it looks like the quarterly AI revenues actually surpassed quarterly AI capex and depreciation. So people are actually making money on this stuff, right? Now, we don't know if at the end of the day, all of the hyperscalers will make money in the same amount, if all of them will be fine in the sense that they will be able to return of the investments they are making. But it's just another testimony that calling all of them completely defeated, it's a little bit premature at the very least, right? So to sum it up, those three arguments against the AI race or, sustaining the AI bubble: earnings quality, depreciation, sure, okay, but that would hit just reported EPS, not operating cash flow. Again, you've seen Amazon with AWS, you've seen Microsoft with Azure, right? They are seeing growth in that department, right? Circular financing, again, right partially. No revenues, wrong. Because, that survey, which came up with this estimate, measured the buyers, not the seller revenues. So there are revenues somewhere, you just looked in the wrong place to find them, right? So, with all of that, I think at the very end of the day, just keep on being, defensive to some degree, but at the same time, don't be over pessimistic yet, because we, except a few sectors and some sort of a rotation from one sector to the next, we are not seeing a generalized broad market sell-off. And you just need to look at the index, the main benchmark, to see that it's just going sideways. And it's not utterly collapsing. So, although again, we do know August, September, those are the two weakest months of the year. So there may be a little bit of worry for that. But on the other hand, look at the bright side. July was supposed to be the best performing month throughout the summer, right? And it wasn't. So maybe seasonality was just pulled forward, right? And we maybe already seeing a bit of the weakness that we were expecting in August and September. Who knows, right? Still, again, all the rest still stays intact, like the midterm election cycle, so potential weakness approaching the midterm. All of those risks are still on the table. I'm just saying, one thing is to say, oh, the market is fucked. The other is trying to navigate what the market actually deliver week by week, day by day, month by month, and not being carried away by, the flavor of the week or the narrative of the month, right? So with that, I'm going to leave you off and I'm going to wish you a very nice weekend. I'm going to be back next week. And I think, now that I check the calendar, believe it or not, next week may be the 2-year anniversary of this channel, which, as for the results, was very lackluster, not even to, 100 subscribers, but, quite honestly, I don't give a shit. I mean, if I wanted, I could have spent more time in, editing the clips and, making it all nice and cute to look at. I don't fucking care, right? Thank you anyway for those 93 people which are allegedly watching and listening to me and my jabbers every single week. But hopefully we can at least get to 100, like the first milestone, right? Okay, it's time to wrap up. So, as usual, up until next week, be nice and be cool. Nils out.
Mm-hmm. 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 Mm-hmm.